Bonds are one of the most essential tools in the financial world, but many people don't fully understand what they are or how they work. In simple terms, bonds are like loans you give to companies or governments, and in return, they pay you interest over time. But there's much more to them than that. Bonds can help you earn steady income, reduce risk in your portfolio, and even protect your money during economic uncertainty. In this video, we'll break down what bonds are, the different types available, and how they can fit into your financial goals. Whether you're new to investing or just curious about how bonds work, this guide will give you all the answers. Today, we will talk about what are bonds and how do they work. So before we get started, make sure to hit that like button, also subscribe to my channel. Imagine making money without owning any property or running a business. Sounds intriguing, right? Well, this is exactly what bonds can offer you. Bonds are a powerful financial tool that people use to grow their wealth, and yet, many still don't fully understand them. In today's video, we're diving into the world of bonds. By the end, you'll have a clear understanding of how bonds work and why they're considered one of the safest investments. Stick around till the end because we'll reveal some expert tips on how to use bonds to secure your financial future. 10. What exactly are bonds? Let's start with the basics. A bond is essentially a loan that you give to a company or government. When you buy a bond, you're lending your money in exchange for regular interest payments. And at the end of the bond's term, the issuer promises to pay you back the amount you initially invested. Think of it like this. Instead of giving money to a bank, you're lending money directly to a government or company. When you invest in bonds, you're essentially acting as a lender, not an owner. You don't get any ownership or share of the company, but in return, you receive interest payments over the life of the bond. At the end of the bond's maturity period, you're paid back your principal, the original amount you invested. Bonds are usually sold in denominations of $1,000, though smaller amounts can be purchased through bond funds. 9. How do bonds work? When you buy a bond, you're essentially becoming a creditor. You lend your money, and the issuer agrees to pay it back with interest at a specified time, known as the maturity date. This can range from a few months to several decades. The interest you earn is called the coupon, and it's typically paid out annually or semi-annually. Bonds are typically rated by credit agencies like Moody's, Standard & Poor's, and Fitch Ratings. These agencies assign ratings to bonds based on the likelihood that the issuer will be able to repay the bondholders. These ratings help investors determine the risk level associated with each bond. Bonds that are rated highly are considered low risk, while those with lower ratings carry more risk. 8. The different types of bonds. Not all bonds are the same. There are several types, each with its own characteristics. Government bonds, for example, are considered safer because they're backed by the government. These can be U.S. Treasury bonds, municipal bonds, or foreign government bonds. Corporate bonds come from companies, and while they offer higher interest rates, they also carry more risk. 7. How to buy bonds. Buying bonds is not as complicated as it may sound. You can purchase bonds directly from the government or through a broker. Most people buy bonds through mutual funds or exchange-traded funds, ETFs, which pool together money from many investors to buy a diverse range of bonds. This helps reduce risk while still earning a steady return. If you're looking to buy bonds directly, U.S. Treasury bonds can be purchased through the Treasury Direct website. For corporate or municipal bonds, you may need to go through a brokerage account. Alternatively, buying bond funds or ETFs can give you exposure to a broad range of bonds without having to pick individual ones. Bond funds are often recommended for beginner investors because they provide instant diversification. A bond fund can hold hundreds of different bonds, helping to spread out the risk. 6. Why do people invest in bonds? The main appeal of bonds is their stability. Unlike stocks, whose value can fluctuate wildly, bonds are a more predictable investment. Investors looking for a steady income or seeking to preserve their capital often turn to bonds. They're particularly appealing to those nearing retirement or anyone who wants to balance their portfolio with safer assets. Bonds can also help reduce the overall risk in an investment portfolio. They provide income through interest payments while offering a relatively stable value. This makes them an attractive option for people who don't want to rely solely on the stock market for their returns. For example, during times of economic uncertainty or when stock markets are volatile, bonds often perform better because of their stability. For retirees or individuals seeking predictable income, bonds can be an excellent option. They provide regular interest payments, often more consistent than the potential for dividends or capital gains in stocks. Additionally, bondholders are paid before shareholders in case a company faces financial troubles, offering extra security. 5. What is bond yield? Bond yield is a term you'll hear often when discussing bonds. It refers to the return you can expect to earn on a bond. There are a few ways to calculate bond yield, but in simple terms, it's the annual interest payment divided by the price of the bond. Yield can vary based on interest rates and the bond's credit rating, so it's important to understand what yield means before you invest. 4. What affects bond prices? Bond prices move up and down based on interest rates. When interest rates go up, bond prices usually go down. This is because newer bonds will offer higher interest rates, making older bonds less attractive. On the other hand, when interest rates go down, older bonds become more valuable. Bond prices are also affected by the creditworthiness of the issuer. If the issuer's financial health weakens, the bond's price can fall, and the risk of not getting paid back increases. 3. Risk involved with bonds. Although bonds are considered a safer investment compared to stocks, they are not without risk. The main risks are interest rate risk and credit risk. Interest rate risk is when interest rates rise, causing the value of your bonds to drop. Credit risk is when the issuer of the bond defaults, meaning they might not be able to repay you. To minimize these risks, many investors buy bonds from reliable, creditworthy issuers. 2. Advantages of bonds. Bonds offer several advantages. They provide a regular income stream through interest payments. They're generally less volatile than stocks, meaning they can help balance out a more aggressive investment portfolio. Bonds can also help you preserve your initial investment, making them a safer choice for conservative investors. Additionally, if you choose tax-exempt bonds, you may benefit from not having to pay taxes on the interest. 1. Final thoughts? Should you invest in bonds? Now that you understand how bonds work, you might be wondering if they're right for you. Bonds are a great option for people looking to stabilize their investment portfolio and earn a steady income. However, like any investment, bonds come with risks, and it's important to evaluate your financial goals before diving in. If you're someone who prefers lower-risk investments with predictable returns, bonds might be the perfect fit for you. What do you think of our video? Let me know in the comment section below. Before you go, please hit the like button and subscribe to my channel. Thanks for watching.